If you're just getting started with investing, the hardest part isn't risk. It's not picking stocks. It's figuring out where to begin. Because suddenly you're hearing about 401ks, Roth IRAs, brokerage accounts, index funds, high-yield savings accounts. So let's slow this down. If you're brand new to investing, don't worry. There is an order that makes sense, and it's not random. Before you invest a single dollar, you need to build yourself an emergency fund. 3 to 6 months of living expenses in cash. Not because cash earns a lot, but because investing works best when you don't need to touch it. If your car breaks down or you lose a job and your only money is in the market, you're forced to sell at the worst time. So first, let's talk about a better way to save. Ideally, you would build your emergency fund in a high-yield savings account, which is simply a bank account that pays higher interest than a traditional checking account. It's safe, it's liquid, and it's not invested in the stock market. Once you have a solid emergency fund in your high-yield savings account, you can start making intentional decisions in your investment account. For most people, their first real exposure to the stock market is in their 401k, even if they don't realize it. A 401k is a retirement account offered through your employer that allows you to contribute money from your paycheck before it is taxed. That money gets invested into things like mutual funds or index funds, and it grows without being taxed until retirement. Once you retire, that is when your money is taxed, so be careful how you withdraw. But let's take a few steps back. Yes, if you have a 401k, you are already investing in mutual funds or index funds. Most people don't realize this. As complex as all of these things sound, getting involved is easier than you think. Okay, moving on to tips and best practices for your 401k. If your employer offers a match, for example, they match 4% of your salary, that is essentially free money. If you contribute 4%, they contribute 4%. That's a 100% return immediately. No stock pick guarantees that. So if you have a 401k, your first move is simple. Contribute at least enough to get the full employer match. Now, here's something important. Inside your 401k, you usually have to choose your investments. Most people unknowingly leave their money sitting in cash. So here's a simple setup you can use. If you're unsure what to pick, look for a broad market index fund or a target date fund that matches your retirement year. A target date fund automatically adjusts risk over time. You don't need to build something complex. You just need to make sure your money is actually invested. Once you've captured your employer match, your next move is often a Roth IRA or some type of independent post-tax account. A Roth IRA is an individual retirement account you open on your own. Unlike a 401k, contributions go in after taxes. But here's the benefit. Your investments grow tax-free. And when you withdraw in retirement, you don't pay taxes on the gains. For someone just starting, that's powerful. What should you put inside your Roth IRA? Keep it simple. A broad index fund that tracks the overall market. You are not trying to beat the market. You are trying to own a piece of it. Once your Roth IRA is funded each year, you can go back and increase your 401k contributions beyond the match. At this stage, the most important factor isn't return. It's your savings rate, the amount of your income you are consistently investing. That is because you are employing two very powerful strategies to help you grow. Compounding interest, where your money earns money and then earns money on that money, and dollar cost averaging, where you invest consistently over time regardless of market conditions. A proven system that keeps you growing as long as you are consistent and disciplined. At this point, you have enough security and skin in the game to consider opening a brokerage account. A brokerage account is a regular investment account without any special tax advantages. It allows you to buy and sell stocks, options, ETFs, and other investments freely. But because it doesn't offer tax benefits like a 401k or Roth IRA, it usually comes after you've maxed out those accounts. Skipping the tax-advantaged accounts first is like ignoring a discount. The order matters. So what should you actually invest in? Start with dividend stocks. Dividend stocks are companies that share a portion of their earnings with shareholders, usually quarterly. Dividends can signal financial strength and provide income on top of long-term growth. Then, gradually start adding what you know. I mean it. With research, of course, but the best way to start is investing where you already spend your money. Where do you get your coffee? Who's your cell phone provider? Even grocery stores and some of your favorite clothing brands. Don't overlook anything when building your personal brokerage. It's your place to experiment with investing. So, if you're just getting started, remember this order. Step 1. Emergency fund. 2. 401k match. 3. Roth IRA. 4. Increase contributions. And 5. A brokerage account. If you'd like the next video to walk through exactly what to put inside your 401k or Roth IRA step by step, let me know in the comments. And if this made investing feel less overwhelming, subscribe. We're building this from the ground up.